That worked. Let me welcome you then to the Moving Capital panel. I am Jan Piercy from ShoreBank Corporation, which is the first and largest community development financial institution in the United States, and it also works internationally. And I will introduce my panelists in a moment. We wanted, though, if we could, to get a sense of who we're in dialogue with, so I want to ask you a few questions before we begin. First, we realize that on the panel we have experience from the United States and the UK, so we're interested in knowing, by a show of hands, how many of you are not from the United States or the UK, but bring experience from other places? Very good. Well, we count on you, as this dialogue proceeds, to enrich the discussion with the experiences that you are having and the issues from where you are. How many of you are accountants? A few show of hands. Okay. And you can define yourself in more than one category. How many of you would regard yourself as social entrepreneurs? Okay. How many of you would say you're in business? Okay. Okay. And how many of you are journalists or researchers or people who in other ways are following the evolution of this phenomenon? Great, great. No. We panelists are in awe of our audience. That's really very helpful. And let me just say, if one or two of you have a sort of burning question or issue that you came here today because you want this panel to address, if you can frame it in a sentence or less, we would really be very happy to take one or two of those to guide us before we begin. Anyone want to tell us what you really expect or out of this panel? Okay. Well, one here, please. And when you speak throughout our panel, would you please identify yourself?
My name's Cordelia, and I have a business in Ghana, West Africa.
Great.
And my question is, given the fact that most of Africa and most Africans are excluded from the formal banking sector, how can capital be got to the many social entrepreneurs that are working there?
Very good. I think this discussion will be proceeding in a couple of levels. We have on the panel, and this may be a good moment to introduce them. Our first speaker will be John Elkington, who has just completed a survey with Skoll and other support on growing opportunity, entrepreneurial solutions to insoluble problems. And that survey is looking at what the needs and the demand are, and John will be talking to us about that when we turn it over to our panelists' opening statements. I think and then we will next go to Arthur Wood with Ashoka, who has joined Ashoka from investment banking, where he is doing the business entry initiative and creating social financial services, looking at ways to engage the major financial institutions, the for-profit financial institutions in this sector with for-profit objectives, not simply for their corporate social responsibility or for their philanthropy, but as a mainstream line of their business. And Arthur will talk about the spectrum of intermediation that is growing now that does address your question, or is trying to bridge the current gap of where financial and other services are available to take enterprises to scale or to provide access to finance in a variety of ways that it is needed. So those will be our two overviews that will launch our conversation. And then we will look at a particular enterprise with Penny Newman, CEO of Cafedirect, which is the UK's largest 100% fair trade hot drinks company. She has been CEO for 8 years. And Cafedirect is an unconventional business model. It is very definitely a business that has both financial and social returns. And Penny is going to talk to us about the experience of Cafedirect as it's continued to innovate and has achieved one level of success that is in turn created another set of challenges with which she is now grappling, but I think very much modeling a direction that many other enterprises may be able to take. So that is a specific experience that we'll have a chance to understand a little bit better. We will go from Cafedirect to Bridges, Michele Giddens, and Bridges is a venture philanthropy, well, a venture fund. I started to say venture philanthropy fund. That's totally wrong. A venture capital fund with a twist that grew out of the Social Investment Task Force in the UK in 2000 that was looking at ways to use the private sector as well as government, as well as the citizen sector, to address those areas of the economy that were not flourishing. And Bridges has had a, I think, very exciting trajectory and is now raising a second fund. So we will hear about the Bridges experience. We will then go to Tim Reith, who is with Community Innovations founder and director. And community innovation is supporting individuals and organizations combining entrepreneurship and social change. And he is also working with a government program and is bringing a variety of support to bear in this emerging sector. Now, when we got together to talk about this panel, Moving Capital, in some sense, as I listened to the discussion, what we're actually talking about is redefining market rate return. When we talk about market rate return, it has generally been a synonym for financial return. Yet there are many other kinds of return, employment, that have always been the case for businesses. And now we're talking about enterprises that deliver social returns, deliver financial returns in a variety of ways. And this is the ground, this is the terrain that we are all, I think, innovating in and trying to expand and take further, without wanting to be seen simply as a sidebar of corporate social responsibility or socially responsible investment, but the entirety of what we define as return and what we're engaged in, what kind of returns we're engaged in and leveraging in doing business. With that, I would like to turn it over to John as our first speaker for the panel.
Thanks, Jan, very much. I have to say I feel a complete fraud here this afternoon. My colleagues would laugh hysterically if they knew I was here, and two of them are in the audience, speaking about money. I've set up a number of organizations, one of which celebrates its 20th anniversary this Friday, SustainAbility, but the money part of it, the financial bottom line, is the piece I've never really totally understood. That's by way of, so you know what sort of discount factors you can apply. I think the most upsetting board meeting I ever attended was the one where Ben & Jerry's was deciding to sell out in general, but specifically to Unilever. And it was... It was upsetting for two reasons. One, right in the middle of the board meeting, we were hit by Hurricane Floyd, so we had to sort of head back. We were on an island off the coast of Georgia. So we had to get back into this sort of column of about a couple of million people heading inland. But it was upsetting for a very different reason as well, and that was, we've seen a number of early social and environmental entrepreneurs getting to the point where they have no option but to sell out. And I think Unilever itself, and I've talked to them a number of times since, learned a lot from that process. And in fact, I've just joined the board of a venture capital outfit in California, where Unilever actually, instead of buying in companies, are putting a very major slice of funding into an independent venture fund to invest and bring on ventures, both in the social, well, they're looking at health, well-being, and sustainable lifestyles. What was really interesting, that sustainable lifestyles piece was very much an afterthought. They just tacked it on. I mean, they admit it. And then suddenly California, CalSTRS, CalPERS, all these other people are suddenly putting big slugs of money into stuff with sustainable on the front. So it actually turned out quite well. Let me just say a couple of things about, Jan mentioned this report. I hope some of you will have had copies and had time to read it. We have, SustainAbility has a 3-year program with the Skoll Foundation. And one of the things that we hope to do is an annual survey. And in this first one, we did a quantitative survey of something over 100 social and environmental entrepreneurs, many of whom were not-for-profit, but some of whom were for-profit, and some were hybrid in the middle. And then in addition, we did something over 20 in-depth interviews. And one part of that report looks at the funding mechanisms that those entrepreneurs are currently using. It's just worth making a point right at the beginning that the overwhelming problem that these people believe that they currently have is getting access to sufficient capital to do what they want to do, and particularly to scale it up. But even now, they feel squeezed. And if you ask me if I have a single great concern in this area, it is this. I think it's wonderful to see the flows of capital that are now coming into this area, particularly from the foundation sector. But I wonder, and this is a question to the audience, whether we are possibly in danger of creating a huge, 1,000 flowers blooming, without necessarily then the resources to take them to the necessary next step. And that's what capitalism does. Capitalism has these extraordinary feeding frenzies or periods of blooming. We saw it in biotechnology, we're seeing it in clean technology at the moment. And then there's this vicious shakeout that follows on. And so the question is, are we going to see a shakeout in this area? It's actually very difficult to kill NGOs, and it's very difficult to kill not-for-profits. But maybe we will see a very difficult period. And one of the things that we do in the report is to look at 10 different routes to money which entrepreneurs in this space are currently taking. I won't give detail on each of them, but the 10 are fishing in their own back pockets, which if you're in the mainstream area of entrepreneurship, that's what people very often do, or they hit on their families or friends or whatever. This is very low. This is number 9 for social and environmental entrepreneurs, and most people are not terribly keen to do that. Public fundraising is the second one, and entrepreneurs really like that one because it gives you unrestricted funding. That came in number 2 on the listing. One of the ones that was surprising was in-kind help. Volunteering, for example, is one way in which entrepreneurs get support, but this is way down. This was number 7. The one that really came hammering in right at the top, and this is both exciting if you're a foundation, but worrying if you're anything else, was foundations. And one of the entrepreneurs we talked to basically said, this is the landscape we know. Well, I think what we're going to talk about in the panel is branching out into different parts of the landscape, or possibly even different landscapes. Some people are lucky enough to get prizes. I mean, Alcan has a prize for sustainability, and Barefoot College got that, and that was worth $1 million. But I mean, we can't all count on prizes. Government support, public sector support, very important. That came in at number 4, with even the not-for-profits focusing on that. Sales and fees, again, important. And it came in at number 3. And quite interestingly, a number of the entrepreneurs said things like, that's where you begin to get feedback, real feedback from your customers, because they're paying for what you're giving them. So that's an important one. For me, one of the surprises was franchising, which if you were in a mainstream business area, that would be an obvious one. And I know Giroud Billamoria is one of the entrepreneurs who's going down that track with Child Savings International, Aflatoon. But most people, it just simply wasn't on their radar screen. This isn't a mainstream option for most entrepreneurs at the moment. Joint ventures, that came in at number 6, but 2 big concerns around joint ventures, and that includes, for example, relationships with mainstream big companies. The first was just how do you go about identifying suitable corporate partners to do the things that you want to do? But secondly, if you've identified the right corporate partner, how do you actually negotiate a fair deal? And many of the entrepreneurs really felt, and particularly in the in-depth interviews, and I'd like to acknowledge Maggie Brennicke for the work that she did right the way across this project. I mean, this was something that they were deeply concerned about, and people were saying, we need brokering, we need help in identifying these people and then going through the discussions. A couple more just to end off. One was venture capital. And I know that people are enormously concerned about the sort of the vulture side of the venture capital world. And this didn't come that high. It came in at number 5. But fascinatingly, I found a very high proportion of people felt that they were going away from foundation funding, and that within 3 to 5 years, they would be much more reliant on generating their own revenues, and that they would be in deep discussion with venture capitalists. This list included some clean technology people who I think that's a very natural form of funding for them. I just raise a question mark. I wonder whether all social entrepreneurs know what they're talking about when they talk about venture capital. Because one of the interviewees came back and talked about we're looking forward to getting venture capital gifts, which struck me as interesting. And then the final one was IPOs, initial public offerings and market listings and things like that. This was way down the list. There were just a couple of people talking about that. And John Wood of Room to Read, who many of you will know, just made the comment that the financial markets that serve not-for-profits, NGOs, social entrepreneurs, and so on, at the moment, I quote, are blatantly inefficient. That's probably putting it kindly. And just so final comment from me before handing over. One of the things we did was just to try and do a very, very rough analysis of the funding coming into this space versus funding coming into other spaces. And we reckon that if you're really quite generous, something like $200 million a year is coming into social enterprise from the foundation world. If you look at clean technology, something considerably over at the moment, $2 billion is coming in a year, so quite a difference there. And if you look at philanthropy just in the US, you're talking about well over $200 billion. So this is still very small, but it's growing very fast. But I just leave you with the question, are we growing a huge number of ventures which for a variety of reasons we're then unable to sustain into the next period of their lives and evolution? Thanks, John.
You might just want to clarify on your 200 million and your 2 billion, is that UK, US, global? What's the frame of reference?
The 200 million is global or international at least. The clean tech, well, all three, no, sorry, the first two, the foundations into social enterprise and the clean technology ones are international. The third one is very much just the US. And that's where the figures are easiest to come by.
Good. Before I turn it over to Arthur, I would say that what you're hearing from us today is we've conceived of this as kind of a continuum, and we should really have had a chart up here behind us on the wall. If you think about grant funding or philanthropy on one end of the continuum and venture capital seeking full aggressive financial market rates of return on the other, along that continuum, there is a great deal of innovation going on. And now, more excitingly, I think in the past that's really been very stovepiped. So if you were seeking the philanthropic dollars, you were looking for a grant. And if you were looking for investment at the other end of the continuum, you were engaged in a negotiation about financial return. However, now, and this is what Arthur will talk about, not only is there blended value in the middle, where investors, for example, in ShoreCap International are looking for a financial rate of return, also a social return that can be measured, and they're blending that because both goals are being met. In addition, though, which is very exciting, is the kind of intermediation that can say, look, the philanthropic dollar can be thought of not only as a grant, but as buying down the risk to induce in the private sector investor, and all sorts of variants on the model that you'll be hearing more about as the panel proceeds. Arthur.
You've saved my speech for me, Jan. I have to admit it was actually myself that planted the question about the accountant. Primarily, I wanted to discover who was potentially more unpopular than bankers in the audience. What I want to do is just sort of set the scene of the scale and scope of the problem, and then sort of talk about what the mechanisms we currently have, and then go on to sort of touch on a number of things which we believe are emerging between this point of minus 100 and plus 5% that Jan referred to. I think when you look at the scale of the problems that we face, which everybody here will know extremely well, you can only be overwhelmed at the size and scope of them. And I think the fundamental message in here as well is that potentially it's only going to get worse. And the reason it's going to get worse is because of an aging population and a reduction in the tax base to pay for that population as you go forward over the next 30, 40 years. The worst case scenario is Japan, where the number of people is going to go from 28% over the age of 65 to 70%. If you take Germany, the tax take to maintain the system has got to go from 20 to 40%. Or if let's take the second best case scenario in the G7 countries, Canada, where roughly it's estimated that $300 billion of liabilities, but if you're reasonably cynical about productivity and the size and scope of the problem, it rises to 2.1 trillion. And the bottom line is that the people we serve are at the very bottom of that food chain. And no matter how wonderful you feel about Bono in this generation or Geldof of my generation, the practical reality is when shove comes to push, the system we have in place to maintain social security payments, pensions, etc., is very much under pressure. One element of the positive element of that we've seen really sort of post-1980 as the state has withdrawn is events like this that I guess reflect the vibrant nature of civil society and its growth filling that gap as the state withdraws. But I think the fundamental point is that is only going to get worse. If you look at the capital market to address those fundamental problems, there are basically two mechanisms that currently move in real scale. There's the state system, which, even if you don't accept it, is intellectually inconsistent at the international level in terms of how we've delivered capital. The practical reality is that we have allocated $2 trillion since 1950, 1960. We continue to deliver $100 billion a year. But the frictional costs in allocating that capital are estimated somewhere between 20 to, worst case scenario, 80 cents on the dollar that comes back as flight capital out of the system. And we asked the question, why is sub-Saharan Africa poor? Well, that's clearly the reason, if 80 cents is not even arriving, and even assuming the 20 cents is spent properly. But again, back to the demographic point, that system is unsustainable even if you believe in the logic of it. The second is the market system, which is huge in the United States, and these are all McKinsey figures. The social capital market is roughly $1.3 trillion in size. But the shocking statistic is that only 3.8% of the entities have revenues of larger than $10 million. And when you realize that includes schools and universities, you begin to realize how fundamentally fragmented the market is. And the cost of allocating capital in that is estimated, again by McKinsey, at 22 to 48 cents again on the dollar. Ignoring the fact that it's worse than that, and it creates a whole range of small entities, none of which have economies of scale. So the two main mechanisms for delivering capital are taking somewhere between 20 to 50 cents off the dollar before they even arrive in terms of frictional costs. And why is that? Now, I asked the question, who are the accountants? In some senses, this problem is the accountant's revenge, because we define things by what are not-for-profit and for-profit. Well, let's take that in what we mean by that in basically product terms. When we talk about not-for-profit, we basically refer to the foundation system. And what is the foundation system looked from a financial perspective? It's a closed-end investment trust company that invests 5% of its assets for a social objective. And the nature of that structure means that there is a competitive advantage for capital in terms of fragmentation rather than collaboration. So you end up in a system that creates fragmentation rather than a desire to collaborate. In terms of the for-profit element, what do we mean by that? Well, in essence, we mean iterations of venture capital models in one form or another. Now, I'm not very good at mathematics, but even I know between +5 and -100%, there are a range of points on the graph. And the range of points on those graphs would reflect many of the cases that we've seen today. We live with this paradox about for-profit and not-for-profit, which has the effect of crystallizing people in two positions. For as a social entrepreneur, you go and raise funds, you spend 40–50% of your time trying to raise funds, assuming you've then got through that system and you're successful. They go, good God, you're successful, you're making money, and they then throw you in with the venture capitalists and the competition you face at that end. A complete sort of paradox and paradigm shift in terms of moving to scale. Let me, however, suggest a slightly different solution, which we can give you some examples of, that we look at this as almost a credit issue, in the sense that the things we invest in are small, what bankers would call junk, triple Cs. But how about if we could actually create a process whereby we collaborate in scale together, move these to a size of about 30–40 million, and actually, by financial engineering, increase the credit quality of the things that we're investing in, from what we call triple Cs to double As. The effect of that, obviously, would be to increase the size of the capital market that we're trying to address, and it would have the effect also of reducing the rate of interest that the payers pay. Is that a dream? No. Those types of structures have been structured in the course of the last year. They were done with microfinance, something called Blue Orchard, and we have been working with Deutsche Bank in terms of actually structuring. Somebody mentioned how do you get capital to Africa, in terms of an I-fund with the International Association for Prevention of Blindness. And this structure will create somewhere between, first tranche, $25 to $40 million for treatment of eye care, and it will provide that capital at around about 4 or 5% in terms of these entities in India, Paraguay, Africa, etc. Now, if you think of the alternative to those players, they're either sourcing capital through the traditional grant-making route, which is costing them 30–40% in terms of capital, or alternatively, they're trying to get capital from the capital markets and as a one-off entity, which is near on nigh impossible. So the reason we've done this is to do a number of things. Firstly, that objective to provide capital at 4 or 5%, layer it, building capacity grants, create a system that moves in scale. But secondly, to demonstrate that there is a margin in collaboration as opposed to a margin in fragmentation. And that's absolutely intrinsic in terms of creating mechanisms that draw together to people to move collaboratively in scale. The second thing that we're trying to do to address this point between minus 100 and plus 5% is we're just about to launch something called Social Investing Ventures, which is where we are looking for people who have systems-changing ideas in finance. We discovered we have roughly around about 15 or 20 on our 2,000 social entrepreneurs. We'd want to move this to roughly 15, 20% of all our fellow elections as we move over time. And it's the specific objective of finding systems-changing ideas that are between, again, this minus 100 and plus 5. The third element, which is absolutely key and is partly reflected in the legal agenda that you're seeing bubble up in the United States, clearly in the United Kingdom, in Holland, and a couple of other jurisdictions looking at this, which is legislation that actually breaks down this definition of not-for-profit and for-profit. And the extent to which you can break down the definition of for-profit and not-for-profit means that you can have within one entity both for-profit and not-for-profit players. This, in some senses, gets past this issue of metrics, because as opposed to thinking this is the dollar goes in and what's the metric that we're going to measure. Because if you think about our sector, there are 160,000 different definitions of value in our sector. Not a function of creating more metrics, and every time I come to events I see another 200, 300 appear. It's an issue of how we, in a mezzanine structure with a range of different investors, which is exactly the structures that you're seeing emerging, recognizing that different investors have different social and economic parameters. It's not about providing one unitary to one solution, and it's about reflecting that reality. And the extent which I think is most exciting are these potential legal structures that are currently bubbling up, which are basically indicating this breakdown between for-profit and not-for-profit. Because under that particular process, you can see a range of different investors coming in. You can see a different role, frankly, also for foundations, which is, in essence, pricing the risk as opposed to making the direct investment. And I put one thought to you. Under the current foundation system, what happens is that you have a cost of capital which is 23 to 48 cents on the dollar. But in top of that as well, it creates this fragmentation. How about if we learn to collaborate not only amongst ourselves, but also for the for-profit world to bring for-profit capital in to actually move these things in scale? Thank you.
Thank you very much. And before I turn it over, I should, for those who have wandered in, say this was Arthur Wood with Ashoka, Innovators for the Public. And it may be, that's an important point because you referred to the fellows. And for anyone who's not familiar with the Ashoka system, Ashoka has over the last now 30 years, I believe. 25, I'm aging it. 25 years identified entrepreneurs in the public interest around the world, very significantly in the developing world, and supported them. And then, so it's intriguing to me that the work that's now being done, very sophisticated work to access the full range of the market, is demand-driven by entrepreneurs who, most of whom started out very, very small. And they're in all fields. They're in education, they're in health, they're in clean water, they're in technology. So I think that's sort of it's very intriguing to me that it was that demand that drew Ashoka to become engaged in a very sophisticated way with how we can break that barrier. Next, we have the opportunity to talk to Penny about Cafedirect's experience and its challenges for the future. So we can really zero in now on a very particular venture.
Yeah, I'm going to just put and share with you my experiences. And in fact, when I was reading last night The Growing Opportunities, I felt I was reliving my past of a couple of years ago in trying to raise money for Cafedirect. Just to give you a bit of background about Cafedirect, the size we're now at is a £22 million company. I think we're one of the well-known brands in the UK for fair trade. We pioneered fair trade, but also in particularly, we've pioneered fair trade into a business model, not just being a trading model. And that really was at the heart of some of our thinking when we did our public share issue. And the other thing which we mustn't never forget, we're trading with about 37 producer organisations in 12 countries around the world, and we're affecting 1 million growers. So it's very important for us to look at how we raise our capital to ensure that we carry on doing that, because that's really why we're here, is to help them achieve a better life. I joined Cafedirect in 1998. Hands up, any of you who are marketeers? God, thank goodness, because that's what I am. I'm not a finance person. And so I very much got my, when I joined Cafedirect, was I'm going to make this happen. And so I embraced my marketing and selling skills to really help put the product onto the marketplace, help get the supermarkets to take the product. And it really was, make this happen and make it profitable. And it was about a year, 2 years later that I started to develop the business plan for Cafedirect for the next 4 or 5 years. And that's really when I had my wake-up call. Because I naively kept thinking, well, if we keep growing, the bank will keep doshing the money out. And, you know, that's really naive, isn't it? But typical marketing, you might say. So out of my business plan came that we needed some money. And rightly so, our founders, who were 4 NGOs, rightly said to me, you know, you've been the kid now, you're a teenager with spots, and God, aren't you stamping your feet? And you better go and do it yourself. And that was the right thing to do because, you know, we were here to make it happen. They'd given us the seed money. Now we had to prove that we were consistent in building a profitable business model as well as a social model as well. So the business plan told me we needed £4 to £5 million. And one of the things that constantly I kept on thinking, no, let's go and get a 5th shareholder. This will be easy. This is because I want that money and I need it and we need to act pretty fast. But I really enjoyed, this is when I think our founders and also our producers really sort of got me grounded, which was we wanted to really take this and really not make it into trade, but a business model where people who grew the coffee and tea and cocoa got really connected to people who drank the coffee, the tea and the cocoa as well. Not just through trade, but owning and facilitating the vehicle that really brought them together, which was the brand, the company Cafedirect. And so we decided, therefore, to not go and find a 5th shareholder, but to find many shareholders and to do a public share issue. We started our discussions actually with farmer organisations. We invited them all over to Eastbourne. I don't know why Eastbourne, but we did. For 2 or 3 days, really, to ask them how did they want to buy into the company, what sort of share offering did they want? Did they want to be gifted, which some of our founders wanted, but did they actually want to pay for their shares? Certainly they did. And for 2 to 3 days, we discussed our governance, how we were to re-looked at our board structure, how we were to govern ourselves, but also what was their role and how could they be owners as much as consumers, and also buy in and work with us on our marketing strategy about how to connect with consumers. By the October, we had that all sorted out, and we went then to develop our marketing strategy. And that was simply, we didn't have the money to do big advertising, but we did, I suppose from my experience at Body Shop, was, you know, the best form of advertising is your product. And so we stickered our products and gave them an 08 number and said, do you want to be part of this? The future is in your hands. And I'm sorry I haven't got a slide, but this is the prospectus. And, you know, the big worry was, and I can tell you it was a worry and it gave me nervous frights, and that's why I've got white hair now pink, is because I really didn't know whether we were going to transform people who brought the product to actually own the company behind it and own part of the whole trading mechanism. We launched on the 4th of February, and by the 21st of May, we had raised our £5 million. The cost of it, and the cost was the prospectus, and the stickering the products, and just all the legal side as well, but it was about 10% of what we raised, which I think is a good expenditure. Just to share with you about marketeers is that one of the things we wanted to do was to make sure that people understood what they were buying into, who Cafedirect, what it was all about, what was our personality, and more importantly, what our values were. And, you know, one of the ideas we wanted to do was to produce a CD, because we wanted to take those people to Ghana, to Africa, to experience what it was to pick the coffee and the tea, and to all what was needed to get them the fantastic drinking coffee. And we couldn't do that because the FSA said we couldn't do it. So we did it in a book format, and here on the one side we opened up, this is the future in your hands, and on one side of the book was how we came about, on the second was all the financials, the risks, etc., and what we were doing and all our strategy, all the things that the FSA would like us to do, and the bank. So we did all that, but we very much created it as our own. And we said this is about having a financial and a social return. It's about both. You know, it was a challenge to us to whether we could get those people. So by the 21st of May, we had 4,500 shareholders. And therefore, you know, anybody who's very good at maths will know that most of our shareholders are quite small, because that's what we wanted to do, was to get people, the public, to engage with the proposition of ownership and being part of this. And so the opening, we said, the minimum you can invest in Cafedirect was £300. And it's, you know, so 300 to 1,000 is about 75% of our shareholders. So it just shows you, and that's what's taught me, is there's people who want to do more than just buy a product before what it means. They want to start investing, and they want to really buy in and learn. And a lot of people ask me, well, now that you're a PLC, isn't this awful for you? And you know, you must hate being a PLC. And I say, no, actually, it's a real learning, because we have now people writing, talking. I'm sure, is any of you shareholders of Cafedirect here? Why not? You will be by the time the end of the session. And but the really interesting is we're getting connection of what people feel about the company. Our AGMs are magical. They last a whole day. And it's a really, you know, it's a learning. It can be sometimes very agonizing for me to hear people's views, but it's really refreshing, because that's what you need if you're going to take it and scale up and listen and engage with everybody. Just to support this, we did change our board structure, because linking more with this, raising this money is, we know we've got to have the resources in terms of the skills, getting the right people to take us on the next steps. It's part of that scaling up. So we have 2 grower representatives on our board. We also have a consumer representative on our board. And prior to that, one of the best advice I got given when I joined Cafedirect was to bring in non-executive directors. And we've got 3 of those as well. And that has really been a really great thing to have, to get that knowledge sharing amongst a group of that calibre. So what's my learning, really, to all of you? Well, one is you can do things that you never thought you could do. And the other thing is I was told about April time to just take, by then I think we had about 3.5 million, 4 million. I got just told to run and take it. I thought, oh, I don't know where I'm going. But no, but it was really quite interesting. I said, no, if we don't get the 5 million, nobody will see that this is a public share, a first public share issue, an ethical public share issue that is really started to make a difference. So whatever you do, any of you who are in that state of thinking, should I go this route, stick it out, work with it, and it's amazing how many people are really, really wanting to embrace and be owners of new, different types of business. So thank you.
For those who are not from the UK, will you just say where this was, the exchange on which this is traded, and how people can buy stock if they still can, because it's a little different.
Yes, it is. And that's very interesting, which is why I think the next development is we listed ourselves on an ethical exchange, which was being developed by our bank, Trados, who I think some of you know and heard about. And it's an ethical exchange, but in fact we've since then moved to Brewin Dolphin. But it is a match bargain process where buyers phone and are matched with the sellers every month. I can give you a telephone number if you would like to have that. But at the moment, there's a lot of people not selling, I can be quite honest. So that's an interesting, is the liquidity of this, which is why I've been calling, and some of you might know, is can we have a different stock market? Because I think there's a lot of companies or organisations like Cafedirect who might feel that this is the right route they want to go. And it's not the only route, but it is the right route. And if the more that go that way, we've got to look at ways of being able to trade our shares. And for some of you, I don't know whether it's been put, but this is our latest annual report. It's a TV guide. That's got to be something of a first. Last year we did a newspaper, so it's massive. But in there's about 45 different microsites to go to actually to get the smell, the feel of what this company is all about, as well as the financials.
Thank you very much. You know, last year, Sir Ronald Cohen, in a plenary address, was talking about the evolution of the capital markets and how they can function in the behalf of a broader array of businesses. So it's very exciting now to hear this very particular account, because these individual stories, I think, really do challenge and inspire us. So thank you. And now we can turn to another example, bridges.
Thank you. I'm
Michele Giddens and...
I don't know if this is working. I might
yes.
stand up and move away from the table if that's okay for everybody. Like somebody who can't, walk, chew gum and think at the same time. I don't think I can talk and sit down behind the table, so I'm going to emerge if that's all right. Thanks very much. A little bit like Penny, I'm going to focus on our own story, Bridges Community Ventures, but just want to say at the beginning that I recognize that, you know, the social entrepreneurship space is such a diverse world. The financing needs are so diversely different, and Bridges has done some work more specifically looking at the non-profit, access to finance for non-profit social ventures. So if people want to ask me questions about that, they can do that. But I'm going to focus on our own experience because Bridges is a private sector venture capital company with a social mission. Sort of a weird combination, actually. We've heard the term vulture capital. That's not the first time that I've heard that. But a private sector venture capital mission, a venture capital company with a social mission is quite a new entity in the world. We think it's something that's going to grow. Our founding charter, and really the reason that all of our team join us, is because all the funds that we will ever raise will have a social purpose, as well as delivering financial returns. And we believe strongly that capital markets can be harnessed to bring about positive social and environmental results. In fact, I would say, certainly I believe, not only can they be harnessed, but they must be harnessed. Because if you look at what's happening in the global economy these days, you have markets creating enormous wealth and growth, but everybody knows that they're leaving behind them poverty, people who are excluded, and environmental damage, which they, by their own inclination, are not taking care of. And I believe that harnessing the power of those markets to make a difference in those areas is crucial. Governments will not be able to do it all. So Bridges is just one very small part of that much bigger equation of harnessing the power of capital to make a social, positive social difference. So Bridges' story, our first fund was inspired by the US, where there are over 60 community development venture capital funds. So our first fund was a community development venture capital fund. What does that fundamentally do? It takes venture capital, meaning buying shares in entrepreneurial businesses, meaning crucially, not just buying the shares and then going, I'll see you in a few years, hope you do well, hoping my shares are going to be worth a lot more in a few years, but quite the reverse, working very, very closely in a partnership relationship with the businesses that you back. So we're bringing that to invest in for-profit entrepreneurial businesses that can help regenerate some of the most deprived parts of the country. That is fundamentally what community development venture capital does. In the Bridges context in the UK, that means that we invest in the most deprived 25% of the country, and being located there as a business is not enough. Because our theory of change is if you pick businesses that are in and very directly located to deprived areas, and then you back them and you work hard with them to help them succeed, there will be social impacts. Now, if those companies are not linked to those areas, that theory of change won't happen. So for us to back a business, it must be located in the most deprived 25%, but it must also be creating jobs for people who live there. Or it must be spending money on suppliers that are located there. Or it must be serving those areas as a target market. So those are our social criteria for any investment that we make. Within the context of companies that can pass that criteria, we then look for winners. We work very, very closely with management teams to help them succeed. I'll just give you a couple of examples to give you a flavor, and then I'll move on to the learnings that we've had from raising money for something like that. So a couple of examples from our early stage portfolio. We invested in a company called Simply Switch. This was the idea of a woman called Karen Darby, who thought that she could help householders save money on their gas and electricity bills. And we backed this idea with £125,000 by making an investment alongside her and her partner in the company, Simply Energy, as it was then called, which became Simply Switch. And to cut a long story short, we worked very, very closely with Karen and her team. The company grew enormously. And 3 years later, we were all able to sell the company. In terms of the way that Bridges reports, we report always on social impact and financial returns. In this case, social impacts, the company moved to a deprived area in South London, over 80 jobs created, mostly for women and mostly for ethnic minorities, many out of unemployment. The company partnered with charities and had raised over £500,000 for charities that delivered customers to them. the social impact side. On the financial side, it was an extraordinary result. In that particular case, our investors made 22 times their money. Another quick example, up in Hull, we backed a label printer that had been in administration. Management team thought they could turn it around. They did turn it around. The end of the story is we sold the company. We saved 50 jobs in one of the most deprived 2% of the country. And our investors made a little over 3 times their money. And the company has grown since it's been sold. In both cases, since we sold the company, the number of employees in the company has grown. So that's the kind of thing that we do. So fundraising, that's what we're really here to talk about today. The first fund was a £40 million fund. The crucial part about our first fund was that the government put in 20 million. They said, if you can raise 20 million from the private sector, we will match it. We never could have raised the first fund without that money. If we'd gone to the private sector and said, we've got a great idea, it's very small investments, only in the most deprived parts of the country, we really think we're going to make a good financial return and we're going to make a lot of good, positive social impact along the way, you can imagine. They would have said, you're lovely, nice girl, maybe I'll give you a bit of charitable money, but there's no way I'm touching you with my commercial money, I'm going to lose it. And I think that a lot of the investors in our first fund did invest out of strong social goals, but there was a level of skepticism about whether we could make it work financially. Second fund, we're just coming towards the end of raising. We've targeted £50 million, and there is no government money in there at all. And the reason for that is this time we're not going and saying we've got a great idea, it's small businesses, et cetera, most deprived locations. We're saying here's our team, here are the exits that we've had so far, here are the financial results, here are the social results. Actually, this looks like a model which can make you an attractive financial return and can make these measured social impacts. That's a completely different sell, and it's not easy, but we are doing well, and I hope to have a positive announcement in terms of a target 50 million entirely private sector fund. So what have we learned? First of all, I just want to say there is a very strong interest in investments that have a social purpose. They excite people. We talk at the highest level of institutions, and we're able to excite chief executives and chairs. There is a strong interest which all of us can benefit from. However, just like any startup business, when you're raising the money the first time, it is extremely difficult. And I think that there is a huge role for foundations or governments. In our case, it was the government that played a catalytic role in allowing us to demonstrate that this could work and to then go on and tap the capital markets by ourselves. But foundations could play that role as well. It is extremely hard to ask social entrepreneurs who are complete startups to go straight to the private sector. That was certainly too hard for us. A third point is that we could never raise the money that we're raising without our board. Now, we have an amazing board. Some members of the board are in the room. They are illustrious, they're incredible, and they have amazing contact networks. But I would urge anyone that is raising money to try to collect some individuals who can add that kind of value to them, because the difference that they can make by opening doors and by helping to advise you on the areas that you may not be so strong on, structuring, finance, etc. The value of your board is absolutely enormous. But the major point that I've drawn from the fundraising that I've been doing over the last few years is social investment is an idea that all of us in this room talk very comfortably about. We talk about merging, we talk about breaking down the barriers between philanthropy, just having philanthropy and profit maximization. That is not where the majority of the private sector is at. They are absolutely still in the box of we invest for maximum financial return and then we give away our profits. So social investment at the moment, we raise our money by going to the top person and maybe capturing his vision, and he makes it happen or she makes it happen through her organization. But there's no guy sitting there saying, my job is to make social investments. Where are the best places to put my money? Having said that, there's real hope on the horizon there, and I think that that is the great opportunity for the future. So we've had a couple of our investors who have, in our second fund, not only said, I'll put money behind bridges because I see your track record, but actually, you've inspired me. I'm going to put together some portion of my balance sheet and dedicate it to social investment. And that's when we really start to see progress. That's when you really start to see scale being built, and if you like, the acceptance of social investment, if you want to call it this way, as an asset class that might start to have people associated with it whose job is to make those investments. That's when you're really going to see a change. In the UK context, there's so much experimentation around this whole area between philanthropy and profit maximization in terms of finance. You've got future builders, big investors in the room, providing very creative financing to mostly non-profit distributing social entrepreneurs of a wide range of kinds, venture capital. There's a lot of experimentation. And there's also a new initiative which might be interesting to those inside and outside the UK that's just been put forward by the Commission on Unclaimed Assets for a social investment bank that would really act as the engine to back all those creative financiers, to really give them access to the capital markets, to break down that barrier that Bridges had in not having a person to talk to. Because if we could have a social investment bank which could play that brokerage role between those who know all about social finance and those who really are in the heart of the capital markets, it could make a revolutionary difference in the ability of this market to scale. So I believe Ronald Cohen is in the room, and I think he might have some copies of the, I don't know if you do, Social Investment Bank, but I would urge you to look at that, because our experience is you can raise the money, you are still pushing water uphill to some extent, and if we can, the more that we all go out and raise it, the more that there will be a guy with his pot of money specially dedicated to social investment. Thank you.
Thank you very much, Michele. And in the second fund, as I understand it, yes. In the second fund, the first fund is very strictly geographically targeted. The second, there's a bit of that you can use for investments that have a positive environmental or other impact that's not strictly tied. So you're beginning to innovate on the model.
The second fund is entirely private sector, and we've taken the liberty to give ourselves a little bit more flexibility. If there are social businesses, they do have to be for-profit social businesses for the money that we currently have, I'm sorry, but if there are social businesses in this room that can make a strong social impact and also good financial returns, we can invest now outside of the core geographies, although our main focus, 75% of the fund, is on the most deprived parts.
And just one other critical question, over what time period did the business plans have to be achieving that financial return? Is your takeout in all instances the sale of the business, or could it have been...
One of the issues in relation to non-profit enterprises is that our exit is usually the sale of the business, certainly the sale of our shares. The time period we would tend to hold businesses would be between 3 and 6 to 7 years, that kind of time period. So this is not really long-term patient capital in this instance? This is patient, but... I guess it's pretty patient compared to a lot of other forms of capital. And what's important, and what I think could really relate to the non-profit social enterprise sector, is that it's tailored for the individual business. We are providing finance we think is going to fit their growth, and then working closely with them. I think that there's a lot of non-profit social entrepreneurs that could benefit from a similar relationship with a funder.
So I hope that some of you are taking from these particular instances I think what Michele and Penny's experience tell us is there's still a lot of need, a lot of room to innovate. So let's all be thinking creatively as we listen to the experience to date. This is a great turning point now to talk to Tim Reith, the community innovation founder and working with Equity Plus, a national network of social business angel investors, and he'll tell us a little more about that. But you heard Michele saying that not all enterprises are to this stage to be able to use this kind of capital. So what about those that are not? And in that instance, Tim comes into the picture. So tell us what you're doing for those who are not really ready to go knocking on the door of Bridges.
Great. Okay, well, I'm also going to stand, if that's okay, and I have a few slides to guide me through what I want to say. Essentially, I'm working with slightly earlier stage investment opportunities, and I guess that this is all part of a developing market, and we're really essentially working with individuals and really the kinds of people that Michele's alluding to, who we think are out there, and we actually know some of them who've made themselves known already, who are wanting to set aside a certain amount of their personal investment portfolio to invest specifically in social ventures. And we're not necessarily just looking for profit social ventures, but looking across a range of different legal models and a range of different investment needs and different social return return areas in which organisations are working. The core work of Community Innovation UK, for those of you who haven't come across us, is essentially we work with entrepreneurs in the social sector who are trying to develop a strategy and trying to be intentional about designing their business in such a way that it will create both a financial return and a social return. We do a lot of work in the area of organisational development. Sometimes that would be seen as investment readiness work, but essentially working with the individual entrepreneurs in terms of their leadership, in terms of their market awareness, and their ability to sell their product or their service, looking at their commercial skills as individuals and as teams, and particularly the sort of financial management systems that they've got driving their organisation. These things are critical when we're working with investors who want to know that these things are in place. We then work with organisations, helping them identify the whole range of financial options that might be available to them. Now, one of those options is the thing that I'm going to go on and talk about in more detail, which is essentially individual business angels that might be matched with them and aligned in terms of their kind of social return that they're looking for and in terms of the financial proposition. But it actually could involve a whole range of different things, and those different financial products will change over the life cycle of an organisation. And we certainly would share the kind of comments that have been made by other panelists about the need to have some grants in there, particularly at the start, looking at some debt finance where that's appropriate as well. And essentially we see a whole range of different financial opportunities that organisations, as they're growing, can take advantage of. We also, as an organisation, help to broker joint venture partnerships. We actually even enter into joint venture partnerships ourselves, where we at times think an organisation's got a fantastic idea and they need some additional skills involved to make that happen. And we want to be involved in helping to broker some of the partnerships that were mentioned earlier by John, in terms of it being quite difficult sometimes to find those things, those organisations where there could be a joint venture of mutual benefit. So those are some of the things that we do in a general sense, and specifically we've got this project that we're calling Equity Plus, which involves helping organisations and individual social entrepreneurs focus on the social impact that they want to create. We want to help them develop financial models that will maximize that impact, and we want to clarify their actual financial need, which is often different from their initial assumption, and it often goes, it can go either way, but we often find that actually really they need more money than they initially sort of identify the need for, and so we kind of encourage them to look at the actual financial need they have, and then we work with them to match that need to the supply of finance, which could be from a whole range of different sources. Once we've helped them work through what they actually need, it's then a process of creating the financial package that's going to work best for them, particularly in terms of the legal structure that they might have, whether for-profit or not-for-profit. And there are a whole range of different legal entities that can be created that we've touched upon already that facilitate this kind of work between investors and investees. We look at the legal structures, the financial products and the legal structures are all there. It's really just a question of being creative with the tools that are already available. And so then it's a question of packaging the investment opportunity so that an organization or an individual social entrepreneur and their team can present that effectively to different audiences that might be willing to invest. And essentially it then involves brokering a deal, and we're involved at that stage in helping those deals get structured and the kind of documentation in place that is necessary. So we have a network of investors, which we are busily working to grow. And interestingly, where we've started, because this is a new project that we've only really just begun, where we've started is with an existing pool of investors that have already made investments into social enterprises in one form or another. And they've used a whole range of different sort of products and legal instruments, but they're all people that essentially understand this kind of blend that we've talked about between social return and financial return. And we're using that existing pool of investors to essentially become evangelists for other investors out there that Michele's alluded to, who we think would potentially be interested in creating an aspect of their investment portfolio dedicated to looking for social and financial return in an investment in a social enterprise. So our investors are now working with other investors that might be completely new to the sector, but as all business angels together, helping each other understand what different people might be potentially interested in investing into, some co-investment where that's possible, and also looking at the kinds of issues that they might encounter in terms of getting into this space, which to a lot of them is new. We don't have any prescribed legal structures that we require of a social entrepreneur or their organisation, and we don't have any prescribed financial products, because we're very clear that actually, as Michele was saying as well, it needs to be tailored to the individual needs of the organisation that's receiving the investment, and obviously needs to meet with the kind of investment profile that the investor wants to create in terms of looking at their personal needs as an investor about whether they might want to exit at a particular point in the future, whether they want a kind of a capital gain, or they're particularly interested in getting ongoing yield income. So there's a whole range of different things that we're looking at, and we don't have any prescribed metrics for how people will measure the social return. And part of that is because we understand that some of the interactions between and the negotiation between the investor and the investee will actually draw out some of these things that an investor will essentially say, these are the things that are important to me when I'm making an investment for social return. And so there'll be a negotiation there between investee and investor. And significantly, because we're not managing other people's money, we don't have a sort of set of criteria that we're working to. We'll get to know the investors that we're working with, and we'll get to know the investees, and we'll help to match the two. But actually that negotiation, we feel around metrics and around that balance between social and financial return needs to be one that takes place between the investor and the investee. Some of the things that creates as benefits are that we have higher risk investments, because it's easier for a social entrepreneur to essentially meet one-on-one with an investor and persuade them to take a risk with them. And as we've already noted, there will be opportunities for the investor also to get on board and say, I want to help give my time and my contacts and my skills to make this as successful as it can possibly be. So those are some of the things that we're looking for. This isn't about donations. It is about investment, and often that can be a start-up stage, which people find quite difficult to fill in terms of the investment supply out there. We also find that this will work where an investment need falls into a gap between a foundation and potentially a capital market, as Arthur was alluding to. That is a significant gap, and it's one that we're wanting to contribute to. So our investors are looking for ambitious leaders seeking high impact, an intentional business model that shows that you've essentially decided on the business model that you're choosing and decided against other potential ways that you could have developed your work, and significantly a team with skills that can deliver and implement the business plan. Just very quickly, because we're kind of running out of time, I'll just give you one brief example of the sort of situation we're talking about. We've got an organisation that we're working with that's got £200,000 of income every year in terms of their turnover. They provide home-based respite care to families who have a child with a disability. They have some contracts with the local social services department who are desperate for this organisation to be able to provide residential respite care so that those children can, say, go away for a weekend, in addition to the home-based interventions that they currently do, and are prepared to fund all of that that residential work with contracts, ongoing income. However, a £200,000 turnover organisation is going to struggle to meet or to raise the £2.2 million that they need to buy the land necessary to develop this facility in the long term. And so they fall between two stools. They could spend a number of years raising that money from traditional charitable sources, and that will take, they estimate, 9 years to do. Or they could work with an investor who will buy the land, help them develop that partnership, and they could be up and running with their new residential centre within 6 to 12 months. That's the difference for them between a traditional form of charitable income, and this kind of model, which for the investor could have an exit, because in their business plan they can see once they get their residential centre established, they will be turning over £1 million within 4 to 5 years based on the kinds of contracts that they're being offered. Now, once that's the case, once they're turning over £1 million, they would actually be able to go to private sector, retail lenders, and they would be able to get a mortgage to pay for £2.2 million worth of assets. They, at that point, would be able to go back to their investor and have a discussion about when that investor might want to exit and how they might be able to buy out that investor's stake in what they do. So for them, you can see, I think, this kind of approach, creative and innovative and bespoke as it is, has real potential to deliver results. And that's all I'm going to say, but really just to say, if there are social entrepreneurs, particularly this is obviously in a UK context, but if there are social entrepreneurs that are in this audience and you're looking for a range of different financial options, those are some contact details there. We also have a number of workshops where we'll explain and go through this in a lot more detail, helping you work out what investment needs you might have. And those are some of the dates, and you can book at the email address there. So I'm afraid a shameless plug right at the end there, but that's great. Thank you.
Thank you very much. I think people are looking for pragmatic resources. Yes. I think the panel does deserve a hand for all of them being succinct and getting that in 8 minutes, and their big incentive was because they want to turn it into a dialogue with you in our final almost an hour remaining. I do have one question to kick it off with to the panel, and before I do that, speaking of questions, you will all have seen when you registered in your packets that you're invited to pose some questions for the closing plenary tomorrow. I think last year there was the feedback that it was a very exciting session, but it was hard to get the questions in. So if you do have a question, please put it in today. I think you can just leave it outside at the desk or email it, and that'll be taken into account for the closing session. So I encourage you all to do that. The question I'd like to ask, I'm going to go back to Penny. It occurred to me that we're talking about financing, and yet, Penny, what you were talking about if it's going to be the high net worth individuals who are the angel investors or those who are investing in bridges, they're going to be high net worth, or they may even be institutions. Yet you talked about, in the public offering, I was struck by what percentage of the shareholders are actually relatively small, so they are not necessarily individuals of wealth. And that then begins to create a dynamic of feeling like you are connected to the grower. And then you were talking about, Tim, the engagement that can occur when the individual investor meets with the entrepreneur, which sounds like something else begins to take place beyond simply the financing. And so I'm wondering, John, in your survey, where the crying need was for financing, I wonder if it was only financing or whether that was a proxy for sort of the support of the stream of other additional support. I just wonder if the panel would like to speculate on that, and maybe start with Penny in terms of what you may have unleashed here.
Certainly, I think if you go in and just think about it that you're raising money, it's too one-dimensional. I think you have to go in and say, look, I mean, with us, we really wanted to get that proposition of connection. That's why we didn't go for a fifth shareholder, why we went the route that we did go. And that's what I would say is, whatever you decide to do, decide what fits what you're trying to achieve. I think that's the first thing. And be honest with yourself. Are you there to try and achieve just raising money, just trying to get the money in? I would say just don't limit yourself to that. Limit it to thinking about how you can grow your knowledge, how you can bring people in to help you grow and learn at the same time. Because appreciate, you can't do it all yourself. And we've only got about 30 people at Cafedirect. Everybody thinks we've got loads and loads of people, but we haven't. And we're a small team and we're learning all the time. And I think the great thing about being a social enterprise is there's no textbook. Sorry guys, but there isn't textbooks. We're finding things every day about how to evolve this. So if you approach raising money or trying to get money as a way of learning, and then I think that's the right thing, and to get that connection. And I do believe that the future is, not through governments and things, but it is about communities and connections. And as I say, I don't fear an AGM. I enjoy it, and I get emails every day from our shareholders telling us what they like, what they don't like about it. And that is really, it keeps you on the edge. And that's what is needed.
Comments from others?
Oh, sure. I just wanted to add something to this because I mentioned that bridges are current funds under management. The social purpose is to do with the geographic location or the sector of the business, but the businesses are for-profit businesses. However, we were approached by so many social enterprises, by which, I'm sorry, I keep making this distinction, which I know is very unfashionable and old-fashioned between for-profit and non-profit, but for the purposes of this, we were approached by a lot of non-profit entrepreneurial businesses that were very exciting, that we would want to back, but that our money wasn't right for. So we did a piece of research into whether this was just a few that happened to have turned up on our doorstep or a greater need. And one of the things that came through very clearly, and we've done a report, it's on the website if anybody's interested, it's quite an old report, but on this point was very clear. There was a lot of challenges in terms of having to get the money in lots of little small pieces from lots of different sources into these social enterprises, all having different reporting requirements, perhaps differing terms of loans, a mishmash. So they could get the money, though. They could get the money to get started, but it was messy. But the other thing that came through very strongly was actually, you know, the money would be great if you set up a fund like this, but could we have someone like you on the board? And so we got that message through very, very strongly, that kind of relationship, when it works well with an investor, like it could be a venture capital investor or an angel investor, and there's this real interaction and there's learning and everybody's working in partnership together. That was something that there seemed to be a real hunger for. I will say, though, I'm sure it's just the same as in for-profit entrepreneurship. Some people just want money and don't want you to bother them. And you know, as Penny says, it's what is right for you, what fits for you.
A survey is just a survey, and I can't speak for the entrepreneurs who either answered our sort of quantitative process or got involved in the interviews. But I don't think that they were largely using "we want money" or "we want financial resources" as a proxy for other things. I think that was a very major headache for something like 3/4 of these people. But they did identify other areas where they had very strongly felt needs. So in raising their profile and the sort of marketing side, that was something that many of them, and Penny, this is something you've done very powerfully over the years. But many of them feel that need to build the brand, build the sort of market positioning, and that is a very particular skill, and there's a lot of timing and luck and professionalism in that, and they don't always feel that they have that. There was another area which was a little bit lower down, but that was team development. And one of the things I think is a real problem in this space is that, you know, we focus on the heroes, we focus on the people who set organizations up, but it's the number 2s, the 3s, the 4s. It's the equivalent of the chief operating officer, the chief financial officer, and so on. They're crucial increasingly. And I think one of the things that came through in tandem with that was quite a number of the founding entrepreneurs were saying, as our organization, as our enterprise gets into a different space and goes to a different scale, we ourselves need coaching, we need mentoring. So back to what Michele was saying. And I think if I'm speaking slightly out of turn and I'm reading between the lines, but my sense very strongly is that many of these people are coming under growing stress. And I think the stress is partly in relation to the funding that they are getting, which is coming in with huge expectations. So they're going to scale, they're going to replicate, they're going to change the world. Well, great, but it's hard enough to set up a normal business enterprise, let alone one that's going to turn the planet inside out. And I think we may be facing, over the next sort of 3-5 years, quite a problem there. And it won't just be a coaching issue, and succession problems amplify this. So those were some of the other issues that came up.
I guess I'm probably coming slightly more left field out of this. There are two elements to this. One is, how do we create funding mechanisms that work for each of the individual social entrepreneurs, which clearly there's highly innovative stuff that's being done by some of the panelists on the table here. The second is when you look at any of these social issues, we would all intuitively realize to actually solve them requires a collaboration of players. Let's just take the favelas in Brazil, but you could take any social issue. That's an issue of law, it's an issue of human rights, it's an issue of education, it's an issue of economics. But we don't fund like that. We all fund in separate, siloed elements. That's the competitive element even within the social sector. Beyond that, we would then say, well, this is the corporate solution, this is the governmental. So we segment it even further. Yet intuitively we all realise to actually solve these problems requires a collaboration to work together. The number of conversations I've had with bankers which have gone along the lines of, and some of them come from the developing world, and they have said, look, we can create mechanisms that will provide funding at LIBOR or less to people in India or Mexico or wherever. But what it requires is the structure to move in $30 million and to be replicable again in that sort of process. And there's the paradox of the opportunity. We all know to actually solve these issues requires a collaboration of players, but the current financing system gravitates against that, and we all try to raise 200,000 million, whatever. If we can actually show the political will to actually collaborate and work together to solve some of these issues, the reality is you can bring the funding mechanisms of the banks to bear, and then the reality to that is then force down the cost of capital, which this sector currently suffers 10 times the cost that the commercial sector is currently allocating capital. So I'd say there are two elements to this. One is the very innovative things that are being done by Bridges, and that is absolutely key, and the deepening of that. But there is also a broader agenda in here in terms of how the sector can collaborate and work together, and how you create intermediaries that create that collaborative behaviour to actually solve these issues systemically. Because otherwise we will continue to not move in economies of scale, and when you ask the man on the Clapham omnibus about how you solve this, he will say government. And the reality is, when you look at the brute reality, certainly at the international level, the frictional cost, let's be polite about it, the cascading of capital from the top down does not work.
Well, thank you for keeping our attention on the macro as well as the micro. We need both. Tim, did you have another thought on this subject before we close and go out to the audience?
Well, I mean, I think only really that this point about intermediaries works at the micro level as well, in the sense that, you know, we are coming across organisations that that need to be working collaboratively in order to get the skill sets on board that they need to grow, and where that happens, I think that's where sort of you build potential future success, and you maximise that opportunity. And B, I think that's where we're seeing kind of investment being attracted, is where people can see I'm funding something that's got that balance and that potential.
Let me take questions, issues, comments, bringing in experience from other countries here in the audience. I think we have roving mics. Right here in the front. And please identify yourself and where you're from when you make your comment.
Thank you. Hi, does that sound on? Yeah. I'm Catherine Sowerby. I'm from Goodwin Development Trust in Hull, and my question is for Penny. I just wanted to know whether there was any concerns in the process of change in your organisation about mission drift and about worrying about the values of the organisation, and whether that would change once you went into this share option thing and then into the PLC. And I just wondered if you could tell us a bit about whether there was worries and if it happened, or yeah. Okay.
Did everybody hear that? Yeah? Right at the back, did you hear it? Are you awake? Right, okay. In answering it, it's a great question, because it's not just about the employees, it's also, I think, people watching what we do, you know, even consumers and other people watching, are we going to walk away from our values? And this was one of our concerns. So what we did, the founders set up a Guardian share company. And they have one share, and this share only allows them to change our mission and our values and our principles. And our values and our principles are set out in our annual report, on our website, everywhere we go. And our mission is basically that we're here to be a leading brand which helps to develop security, influence, and empowerment for farmers in developing countries. Only they can change those values. And so that's what we did. We actually protected our values and our principles and our mission, so that only they can change it. And I don't see those four founders, I don't know about you, but I can't see Oxfam, if they're here, changing that or allowing it. But what I would say, it stopped us. We can't go on AIM by doing that. That's not allowed to happen. So that's where there is an interesting thing I'd like to know, is how can we get into an ethical exchange that allows us to protect our values and our principles. So it's really key. The other thing we did is, as you can appreciate, we didn't want to be taken over. So we also said the maximum shareholding you can have is 15% as well. And that also stops us going on and finding, other ways to have our shares. So we did those two things because we didn't want people to take us over. But one of the things I will share with you, the big debate that I had with myself on the 2nd of February when I went on Radio 4 is, am I talking to those 7% who might give me the 15, or the 7 who are going to give me the 15 because I might need them? Or can I talk to the 4,500 or those many's? And it was trying to get that balance of, because there could be a time that we needed one of those 7. And in fact, we did talk to some big investment to see whether they would be interested in doing that. But we really didn't want to go down that route at all. We really wanted to get to the general public. And, great, we did do that. So that's how we've really protected our values and our mission. Yeah. Did you hear that? The question was, did the shareholders, the rest of the shareholders, know about the Guardian share company? It was in the prospectus. And actually, at the back of the prospectus, which is to fill in the form if you're interested in the shares, you had to sign up. We had, I can't remember the exact words, but you appreciate Cafedirect's gold standard and mission statement. And even now in the match bargain process, we ask that the broker makes it well known and share with them what our mission statement is and our principles as well when they trade the shares. So we constantly reiterate that, what we're doing and why we're here and what's our purpose.
And just for one other illustration, for ShoreBank, which has been a privately held company now for 32 years, and we're looking at how we can more readily access capital and also how we can provide liquidity to our shareholders. And there are really issues within the U.S. structure for trying to take any part of a company public and really protect that mission in perpetuity. It is challenging. And I think there's a lot of innovation that needs to go on there. Other comments? Other questions, comments? See, way in the back here? Or whoever has the mic was probably...
Hi, I'm Andrew Wolk. I'm from MIT and Root Cause. I'd like to know if any of you panelists have thought about the role that possibly independent research might play. I think there's one group in the UK, New Philanthropy Capital, that's started down this path. And there is, I've been looking at a comparison to the private sector and the evolution of an independent research market. Forrester Research, all the private equity Wall Street firms have this sort of aspects of it done by industry sector, comparative, and company level. One person I talked to at this conference talked about the moment in time when a flood of money needs to get smart, and wanted to get any of your perspectives on if you think there is a need, if there is a need, how it might get developed, where the value proposition might be, so on and so forth. Thanks.
I think there is a need, and I imagine, John, you have some thoughts on this one, don't you?
Well, first, yes, I mean, we all do, but first a word of caution. I think we may believe our own propaganda at times, and I think much of the work that we do is working with mainstream big companies and with financial institutions, and they may be excited about some of this stuff at some times, but they're not yet remotely convinced by it. And one of the shocking things was when we first went out to tell some of our corporate clients that we were starting to show an interest in social entrepreneurship. And some of them actually said, quite literally, "Oh, what a pity. We used to like working with you, and you're now going almost out into the outer darkness." So I think that there is a much bigger selling job than we currently have. And just back to Penny's point, I think what Cafedirect have done is astonishing. But those Guardian shares, many social enterprises may go down that same route, but it does put you into a very particular place in the market. And I was very struck listening last night to Mohammed Yunus talking about Danone and the Grameen Danone tie-up. Danone are a complete mutant company. Frank Rebo, who is their CEO, is very peculiar. ShoreBank, you're peculiar too. And I think we should be very careful about drawing conclusions on the basis of a very limited sample of wonderful organizations and companies. We have a huge challenge, and I think the independent research piece is absolutely crucial here, that we have to build up the capacity. But if we build it up externally and completely independent from Wall Street and other mainstream financial institutions, we make a big mistake. We've got to get the Goldman Sachs, the Morgan Stanleys, and the people like that paying real attention. And the problem is, they're not going to come into Cafedirect anytime soon, I suspect.
I'll drop, just to be controversial, I'll drop to a slightly different position. I think what we have seen over the course of the last 18 months has been a real shift, for example, in terms of the financial institutions. When I joined Ashoka roughly 2 years ago, the reaction you would get from the average banker was, there, let me tell you what risk is. They're now ringing me up and inviting me for dinner and lunch, which is always the acid test with bankers. The extent to which there have been real deals done in the course of the last year, for example, to take BRAC, they did a $183 million deal with Citicorp. Deutsche Bank with its range of funds. The Deutsche Bank thing that they're doing with us, for example, is another one. If you look, I don't know if there's anybody here from UBS, but UBS, again, is being very proactive in terms of its engagement of the market. I sense a real change in terms of deals that are being done. I mean, there's been about $1 billion worth of deals done, $400 million worth of deals done in microfinance. There's a deal done by Garvey for $4 billion that's done by Gates. And let me pick up on that point. If you think about Gates, I mean, in real global terms, if you think about Gates is roughly 0.8% of US GDP, of which it will give 5% away, which is 0.04% of American GNP. Or to phrase differently, that's roughly 3 weeks' expenditure by the Pentagon. Now, if we're really talking about creating systems change and driving capital into this sector, look what Gates has done himself. He has leveraged the Garvey funds on vaccinations and generated a structure that has created $600 million or nearly $4 billion that's going to go into vaccinations. And that's not by Gates making it directly, it's by financial engineering and spurring that financial engineering. So I sense there's been a real change in terms of how the banks are looking at. And the issue, when you speak to them, all of them, is not about whether the tools exist or whether it can be done. The issue, they all say, is where's the scale, where's the opportunity for us to invest in? And that gets you back, sorry to bang on about this, gets you back to the issue of collaboration in the sector and the ability to demonstrate that there are opportunities and opportunities they can invest in scale. And one of that element is investing them one by one, but equally there is an element here, back to my paradox of the opportunity, that if you can actually create frameworks, which is exactly what we did with Deutsche Bank, that demonstrate that you can move in this sort of size, then you can bring those tools to bear. But the challenge is as much on the social sector side as it is to be dismissive of the banks and say they don't want to engage.
Do you sense any change in the corporate attitude? Do you think there's, I know John's position on this, but do you sense there's any sea change in the attitude towards social entrepreneurism generally in the corporates? Taking, for example, what we've heard from Branson and Virgin and their plans for biofuel, whether or not you like the idea of biofuels, do we sense any other major corporates starting to loosen up their pockets?
I mean, I can tell you in terms of a number of things that we're doing, for example, which is what we call a hybrid value chain, and which of you attended the 8 o'clock meeting this morning. And what we're doing there is working with McKinsey, trying to bring companies in on a for-profit basis to enter markets. Just to give you a very firm example of that, working with a Manco and redesigning the point at which that company enters the market, which means that traditionally their barrier to entry had been the $12 farmers. How can we leverage social entrepreneurs, how we can leverage civil society to actually drive that down to 2-hectare farmers? Now, when you flip the side of that, that then creates a huge billion-dollar potential market in Mexico alone, replicable again over a series of countries. Indeed, the model is replicable by a range of other issues. And once you talk about that sort of money, that intuitively also gets the interest of the bankers. If you think how we approach this as microfinance. Well, when microfinance is the facilitation to the entry to the corporate to drive economic resources to the bottom of the pyramid, when you then say, well, what's the microfinance for that? Well, that's been done. That was the Blue Orchard deals. And then say, can we actually then securitize the output from those farmers? Well, that's been done in terms of BRAC. And then can that be then packaged on the other side? You begin to look at this again on a systems type of approach, as opposed to, is this about CSR? Is this about banks? Is this about microfinance, which is a tendency in the sector to look at? And when you can start to look at things on a systemic basis, it changes quite substantively the engagement and the collaboration between players. So we're doing a number of these with a number of multinationals, and yes, there is clearly in the more innovative ones, and I hastily add that unfortunately not British ones, and I wish there were more, the extent to which certain companies have very clearly twigged on this, and there is a tremendous opportunity, and a tremendous opportunity that moves in scale.
I mean, just very quickly, and to give a UK example, Marks and Spencer would be one example of a company which is announcing its intentions to, in a sense, go green, and is increasingly looking around for sort of social entrepreneurial suppliers. The problem then being, and this is again back to Arthur's point about the need for scale, is that many social enterprises simply don't have the capacity to supply a business of that size. And I just a very quick answer to Brian's point about how do companies, mainstream companies, see this. If you go back 20 or 30 years, and this is in the report, they saw it as a compliance issue. They were just forced by regulators to do this stuff. They didn't want to do it. They were on the defensive. I once went into a board meeting with a chemical company. They told me, with pride, they were 87% compliant. So I said, you're 30, well, my maths is always suspect, but you're 13% criminal. And they hadn't quite seen it like that. We then went through a period of corporate citizenship, and Arthur talked about corporate social responsibility. I think we're just beginning to come out of that. It's not that that has been a bad thing. It's sensitized and woken up companies, but it is exactly that. And I think we then went through a very difficult period in the early phase of globalization, where suddenly companies like Shell, Nike, Monsanto stumbled into a very different set of issues. But they institutionalize their responses in corporate citizenship or CSR departments. And that's, I think, our collective problem, that many companies view it through a set of lenses which are not entirely helpful. And I think where we're now headed is into a very different space, where innovation and entrepreneurial solutions come absolutely to the forefront of mainstream business thinking. And that's why I started by talking about the way Unilever has gone from gobbling up ventures like Ben & Jerry's to setting up venture funds to try and fund innovation externally. And I think that's where companies increasingly will go. And I think that's a huge opportunity. I agree with Arthur. I think there's a huge opportunity to engage companies, but do not go into companies expecting them to roll over immediately. They are highly skeptical. They've been here before in different ways. We've got a big case to prove.
I was just going to add that I'm also aware that actually one of our investors is a UK company that is doing some very interesting seeding of new businesses in the developing world that are very socially positive. And the reason I think they're doing it is twofold. One is that actually they know that their team, their staff are so excited by things where they can see the impact on, in this case, farmers in Africa. So there's a huge drive, and we see that in terms of the people that we're able to hire. There's this huge drive within the workforce to do things that people can feel really good about. And what I also just wanted to definitely confirm for this example is that this is no way philanthropic. They've done a pilot, and they think that this particular business can do well commercially as well as doing a lot of good, and they're now thinking about whether they might have a sort of an incubator, some kind of incubator within the company that could take the skills of that company and use it in these developing market, bottom of the pyramid environments to make businesses. So I think there's really exciting stuff going on. And I think there was a question about what research and financial research could do. From a personal experience, when we had financial advisors saying to their clients that, yes, we think it's okay to invest in bridges, we were so excited because at the beginning they all said, no, unproven social. No, they say social, that means you're going to lose your money. And that's what they really mean. And having those intermediaries begin to move because we've got some track record was huge. And likewise, in these researchers to whom the financial sector listen could be enormously powerful if they could just do some work in some of the examples where risk and return have clearly been evaluated in a social investment environment. I think there's an enormous potential for that. And New Philanthropy Capital, I don't think are doing it in the UK. They're focused on philanthropy. I keep telling them they should look at social investment as well.
I think we have two comments right here in the middle, if someone can get you a mic.
I've got a mic, but I'm over here.
Oh, okay. Oh, okay. Very good.
I have a question. I'm Andre.
and I represent the network of about 15 social entrepreneurs from Ukraine. And in Ukraine, we don't have any materials, and for example, if you put it in Google, like social entrepreneurship in Ukrainian, you would hardly be able to find a single paper. And businesses who feels like potential funders now of social needs, they don't know about venture capital, venture philanthropy, or social entrepreneurship. They just laugh when we start explaining to them. What would you recommend at this stage of the society development but there are social innovators, there are NGOs, there are social innovators who are trying to seek partnerships and money, of course. What would you recommend to this kind of country? Belarus, Moldova, Ukraine. This is a language barrier, huge language barrier first, because the literacy of English is not very high. And what really could work for businesses? I think I got the answer for the last question, but still.
Anyone want to tackle that one? You've done some work in that part of the world, Michele, in your former life, and it's a challenge.
What really could help? I think that's hard, but there are associations such as the European Venture Philanthropy Association. I don't know if you're connected with them at all, but I know that they're outreaching a lot in Central and Eastern Europe, and becoming a member of something like that, which is looking at, this is still the grant finance, but very often the very important grant finance to get social entrepreneurship off the ground might be where a lot of the enterprises in an economy where it's a less familiar form, they might still be at that point. And I know that European Venture Philanthropy Association has been doing a lot of work in trying to bring people together from that region and to familiarize them with their options. So that would be one concrete thought. I don't know whether it's appropriate. If I could talk to you at the end, I might have some others.
I mean, I'll get the Ashoka plug in. If the idea is systems breaking, ethical, creative and entrepreneurial, then we're certainly very interested in always enlarging our community. We recently elected a fellow in Afghanistan, so I guess Ukraine isn't, on that basis, is probably an easier location to get to.
Okay. And there was some, where is the mic now? I can't see. I have it here. Pardon me?
I have it here.
Okay.
Okay, my question goes with my concern. We talk about markets, money, financing, growing, and not a word for the natural capital. We are living with red numbers. In my country, we say not all that shines is gold. Yeah? What about the natural services, the ecosystem services that are vital for our society? We are making plans like if we would have planned it for in long term, no? We may talk about climate change and not understand a word because it's not an emergency. And it is. How do we put the issue on the agenda? How do we invest in nature? How do we give value, economic value, to the ecosystem services? Climate change and poverty, it's so related. The extreme poverty communities owns the forest and the jungle. I don't know, but I'm concerned that this modern society don't care about the jaguar and the old forest or the butterflies or biodiversity. I'm afraid that we talk too much and we don't understand a lot. With all my respect, thank you. And my friend, John, how do we put Mother Earth on the discussion?
I do want to say that because this panel was talking about financing, we may not have talked about that explicitly, but one of the points we talked about among ourselves is one of the reasons to really drill down and look at ways to creatively engage the private sector is not because any of us believes that everything to be done can be done seeking a financial return, but quite the contrary, so that we are in fact conserving the public resources and the philanthropic resources for those things that don't have, at least in a short run or for part of what needs to be done, they don't have a financial return. And that's what's really key about this. But in fact, much of the innovation, much of the financial innovation is going on directly focused on how we can incentivize much more major scale interventions that relate to climate change and relate to saving the environment. And that's, I see it at least in the United States, I see it growing exponentially. We happen to run the only environmental bank in the United States outside of Portland, Oregon, and the number of people who are coming to our door to say we also want to do this where we're engaged with you internationally. So I believe it is really a growing consciousness.
Can I do a quick thing? Patty, I mean, I think that at Sierra Gorda in Mexico, you're beginning that process. And Jan began this session by asking who in the audience was an accountant. And it's difficult to see accountants as revolutionaries. They're not. But for some time, people have been talking about natural resource accounting. And I think what we're beginning to see now with, for example, the Stern review on the economic implications of climate change is a very uncomfortable awareness that the scale of the financial impacts of climate change are going to be absolutely phenomenal. The opportunities as well. And I think accountants have been very slow to pick up on all of this. And my hope is that as the pressures build, they too will see an opportunity space and they too will start to think about accounting for ecological services. It doesn't deal with your fundamental question of how do you get people to emotionally connect with Mother Earth, as you put it, but it's a stepping stone.
Or just the pocket connected.
Yeah.
Not emotional.
Yeah. But I'd quite like the emotion there too.
But your point about accounting is very critical because we only seem to value what we can measure, and there is very serious work going on now to talk about how do we account for the externalities in measuring return. And I think about, for example, the equator principle adoption only 4 years ago, where ABN AMRO taking the lead when groups were successful in bringing to their attention that there were adverse environmental consequences of some of their project funding. And they knew if they moved out alone, they would be at a disadvantage vis-a-vis their competitors. So they began to go to other investment banks and to the International Finance Corporation and say, what can we do about this? And they adopted originally a relatively small group, but they held themselves to the equator principles that define some standards of doing business that will avoid environmental harm and will seek to add benefits to the environment in the projects that they're funding. And over time, in just 4 years, the number of financial institutions that have subscribed to that has vastly increased. That kind of focus and activism, it's not financing per se, but it's a critical complement to begin to broaden out the horizon.
I don't know which of you has seen the Al Gore movie. I suspect the vast majority of people here probably have. But I'm sure all of you are aware of generation investment management. The business case for generation investment management is on one of the last slides that Gore shows, which says, this is where we are in terms of global warming, this is where we're going to be, and here are the 7 technologies that will actually bring us to where we want to be. And that is a clear indication that, you know, in financial terms, these are the 7 opportunities, if there is political will, that will actually financially drive this from the other end. So the two, in my mind, are fairly closely related.
Jan, may I add one thing? Because I think, there seems to be an enormous wave that is going to carry a lot of innovative financing to combat climate change. If anything, I'm afraid that it might grow into a bubble, and I've seen others having that fear. So I think there's a lot of momentum there, much less momentum around preservation of human and animal habitats and monetizing the value of that diversity of species. And I think that might be a next wave, and it probably requires some government or international government regulation to create some monetization so that the market will value those things. And I've just started to hear financiers talking about that, so I'm hopeful that might be a wave after the wave of climate change. But I just wanted to agree that that part of it, I think, is left behind by the world of finance.
I'm very moved by what you're saying, because I sit here now thinking, actually, I never said anything about our social return, because that's really what you're asking. I think as well is looking at companies such as ourselves, what are we doing not just financially, but what are we doing on social? And I think one of the things going forward is how we define a social return. And we actually did a workshop with some of our shareholders by asking them what they thought a social return is. And it was very interesting to find out. Some of them wanted in very, very simple feedback. Tell me the number of growers that you trade with, and tell me in how many countries and what premiums are going back. While others would want to say, what are they doing about the environment in which they grow the coffee and the tea? How are they coping with climate change? What are you doing on that front as well? And it was very interesting to see the spectrum of people wanting to understand what a social return is. And I think that is the challenge we all have as we talk about what we're trying to do, is being able to cope with the different audiences and the different ways in which people want to hear this. And coming to John's point about collaboration, this is somewhere in the last year we've actually worked with the German government to leverage the funds that we put back to farmers, not by the premium, we put an additional investment back, actually to work them on specific models of helping them to cope with climate change. Because in many years to come, I don't think you're going to get coffee and tea grown in the places that it's grown now. And what we're trying to do is help them to diversify into other crops that is relevant for their future. And we're also trying to do that by them teaching themselves. So it's teach the teachers, help. And Mexico is an area that is very much up for this, and so is Peru. But I think what I'm sitting here thinking, you gave me a very sort of torn heart, because aren't we wrong that we haven't talked about the social return and that we are just talking about the financial? And that's what I take from your question. And I think that is a big thing that we need to all face, is because financials, everybody appreciates the financial value and the financial return. And they are very quick to judge you on that. I think we've got a long way to start working about what we mean by a social return, and to get people on board with that and understanding the scope of that.
Just very quickly, if we were in Mexico, Patty, you'd bring us right down to Sierra Gorda, and here we are in Oxford. Let me just say a couple of quick things. We heard last night that Oxford used to burn difficult people. We don't do that now. We just let them lead out professional lives of extreme frustration. So there is somebody based in Oxford, Professor Norman Myers, who some of you will know, but over 30 years he's been trying to put a cost and a value on ecosystem services. If there's somebody I would like a statue in this city, he'd be one of them. And then also locally, you have universities like Oxford and Cambridge have been very slow to pick up on the sorts of things that you're talking about, extremely conservative and traditionally minded. But here you do have now an Environmental Change Institute, and in fact they've just attracted, I think, a £5 million grant from a major supermarket to invest in climate change and some of these things. So it's beginning. It's a very thin end of a wedge that needs to get much fatter. But there are things going on here on that front.
I don't know where the microphone is, which I think determines the order. So
I've got it.
Will he or she, and I think there's someone who's been holding up their hand right in the middle here for a long time. So let's get it over. Yes. Go ahead.
Oh, sorry. Okay.
I was trying to get the sequence of after you.
Okay, so Jeff Bernand from Investing for Good. It's a question for Arthur. Arthur, I think you mentioned you were working with Deutsche Bank on a structure, and their contribution was to improve the credit quality of the portfolio. Can you just describe how they did that and the costs?
Without getting into too much detail and boring people witless, if you think about, again, looking at this as a capital market, there are two players in this which by definition are happy to secure a loss. They don't say they're prepared to make a loss. They basically say we are prepared to sub-optimize economic return for social impact. But if you think about it, high net worth individuals are by definition with a tax break at minus 100% in terms of grant behavior. and governments as well, in terms of either through objective or inefficiency in terms of the structure. The way the structure works is you have what's called a collateralized debt obligation structure. Now, what the banks do in this is a $200 billion market, so it's not a fly-by-night market. What the banks effectively do in that market is to, in a normal CDO market, is to tranche out the risk. So you, say, would be a hedge fund, you'd want a high-risk, high-equity, high-risk type of investment. Another investor may be prepared to take a bond return for a bond risk, and then, say, someone a third tranche in between. If you think of it conceptually in those terms, if somebody is prepared, as they are in this market, to take an equity-type risk for a bond-type return, in essence, price the risk out for all intents and purposes, the net effect of that, of aggregating the range of players, plus that type of structure, has the effect of increasing the credit structure as a whole. So it's about reallocating the current subsidies in the marketplace, not through the structures that we currently have in place, which is more or less effectively the foundation structure, but finding mechanisms to bring capital markets and capital market skills to these particular types of issue. And in this sense, it's not about a direct allocation of capital. What it is trying to get organizations to price out the risk, which then has a net effect of increasing the quality of the other players.
I'm going to suggest that for the next few we may aggregate some questions so we are able to cover some more because we're nearly out of time. So whoever has the mic speak next, and then we'll take about three.
It's over here.
Okay, good.
It's over here. Hi, Cliff Bryant from Unlimited, UK Foundation for Social Entrepreneurs. A quick comment and a question. Quick comment is, it's great to hear capital finance models being offered which include how to economically get capital to a large number of very small players, because a large number of very small players is fantastic for social capital. And we have to remember here that we're working to build social capital, social cohesion, as well as the direct function of whatever sort of enterprise it is. So great to hear those. The question, if we are looking to move away from securing the social value of an investment through organizational form, we're moving away from not-for-profit legal structures, for example. How else are we going to sustain the confidence of the investor that they are taking less of a financial return in order to gain a social return, without extensive micro-reporting, which will kill stone dead the enterprise in just the sort of way that government funding tends to kill stone dead social enterprises? And I'm just to offer one thought, as people may have, and the panel may have other thoughts about how to do this. I think that transparency is going to be a key route. It is fantastic, the work that's being done on small individual and quite bespoke arrangements around the table, the different models that are being tried there. But if we go to the sort of scale that's being talked about, you can't have individual bespoke arrangements for absolutely everybody. The public need to trust that they are trading financial value for social value, and to know how they believe in that without it being captured through legal form.
Okay, let's take another question, and we'll aggregate about three and then come back. Not sure where the mic is. Okay.
I have a question. May I just go here?
Sure.
Yeah, hi, Michele Palazzi, Progressive Foundation in the Netherlands. Just a thought about, if you only look back, 10, 15 years in many of our European countries, the sort of climate for entrepreneurship was very poor, high taxation, regulation, and we're still not there. So I think there is a sort of trend here about more enterprise, not only in our country, but also in developing countries. And we see, all sorts of initiatives coming up from South America, South Africa, and so forth. Plus what's happening in the ethical investment market. There's a lot of money now moving towards ethical investments. So I think that we heard it last night, I think it was either Jeff Morgan or Charles Hendy, this move towards a decentralized, much more sort of bottom-up and small-scale businesses, small-scale enterprises. So this is really quite a trend. And I think that this is very encouraging in terms of the discussion that we're having here. And I think the second point is, if you look at the Netherlands, if you look at Scandinavia, if you look at Switzerland, Germany, there have been now for 20, 25 years some very interesting banks that have actually been, Triodos Bank and the Banca Etica in Italy and so forth. They're actually being at the forefront of this. And they've funded thousands of small enterprises. So how do we actually help them scale up in a way which perhaps we haven't seen yet? So I think there is a lot of potential for this.
And thank you for bringing in some experience that's beyond the UK and the US. So let's take maybe one more and then, oh, good.
Nigel Kershaw, Chairman of the Big Issue and CEO of Big Invest. we were founded by social entrepreneurs working with mission-driven financiers, which is a great tension, just to finance social enterprise. And my real comment and question is about transformation. Every time somebody drinks a cup of coffee from Penny, there's a transformation takes place. Every time somebody buys the £12 million worth of cover price of the big issue, we transform a homeless and vulnerable house. But that's what drives us. It's that transformation, and that's what drives us to find innovation. That's what drives Penny and myself. And one of the things that happens is that we ask the question, why aren't those big brand names like the Big Issue and Cafedirect, why there aren't any more? And that's the models that I guess Penny's looked at in the way that she found her finance, and we're trying to look at in Big Invest. And we're doing it in a number of ways. One is we're trying to create an affordable credit rating index to bring hundreds of thousands of people into credit so they actually can do and start to live their lives and take control of their lives. But the other thing we're doing, which was inspired by Michael Trail in Australia, Social Ventures Australia, and through Jerry Higgins, is look at a buyout model. And what we want to do is we want to go out and we want to buy commercial businesses, and we want to back them into social businesses, social enterprises that really have the management and the capability to do it, and actually try and transform the sector and grow it. And maybe one hopes that the names of the Big Issue and Cafedirect and a number of other rooms will be the household names of the future.
Great. So really taking it to scale. Can we take the first question with regard to reporting and transparency and what it's going to take to have the kind of information available to drive up the level of investment? In some respects, I think part of the answer was the question we had about independent research, because part of it is going to be a documentation and a transparency that comes from a kind of exchange of information that now exists on companies, but not so much on ventures of other kinds. Do the panelists have other thoughts on what it's going to take there for?
Oh, sorry. Just from my point of view, and from Cafedirect, I appreciate what you were saying. One of my concerns as we evolved was, goodness, I could spend my days just writing reports about what Cafedirect does, and so I could really relate to what you were saying, because, you know, I'm asked to do a social report against the values, and I've got an environmental report and everything like that, so I could spend my days doing it. But I think it's wrong for me to think like that. It's much more important for us, because I do think a part of our values is to be transparent, and so we value our communication. So that's why we've made our annual report more than just an annual report. It's become like a social report, and it's going to be more of that. And we also use our website as well. As I say, we're doing films. We've used other mechanisms of communication, films, Word. You know, as I said to you about the CD, we wanted to do that. We wanted to get people to have that emotion be there, you know, picking the coffee to see the issues that are faced with farmers. So in one respect, I can identify with, oh goodness, you know, you could spend all your time writing reports. But I do think, like you've suggested, we have to be transparent, and we have to find a mechanism of communicating to people what we are doing. But you don't have to do it every month. I think you can do it annually. And we put, I would say, we don't advertise as such. We put quite a lot of effort, though, in PR, into getting out to the media, to all sorts of networks as well, to tell people what we're doing. One of the reasons I'm here today is you can tell people what you're doing. And so I think we have to be innovative of how we communicate. But I don't think we should sit here and think we shouldn't communicate and that it's going to take all our time. We've got an onus to go out to tell people what we're doing and get excited about what we're doing, and to invigorate and excite so that they can take that opportunity and get people to also to scale up as well. If we don't do this, it's not going to get anywhere. So I'm for communicating, but let's use technology, and let's maybe not do it every month, but do it once a year.
Maybe you want one more comment on this, and then we'll go.
Very quickly, I mean, one of the basic problems, take the US model, is that there are 1.6 million 501c3s. And the problem the investor faces is sticks his finger in the air and prays. And that's the reason that a lot of the funds end up in hospitals and schools, because that's what people know and they can touch it and tangibly feel it. So I think there's a real issue here in terms of transparency. I think on the optimistic side, there are clearly things happening on the technology side, and I'll be back to my old word about collaboration aggregation, that will drive this collaboration aggregation. In much the same way as in the financial markets, everybody used to use Reuters and just look at the information. Mr. Bloomberg, as you probably know, made a fortune, and he made a fortune on providing analysis in real time. And I think what you're going to see is some of these types of technologies potentially applied to the type of to the sector we look at. So, for example, can you create a framework that actually aggregates everything around the issue? Let's pick on child trafficking. So, as opposed to try and say I have the best gold standard, which academics argue about till the cows come home, the ability to aggregate in the same way types of things like, for example, Google Earth would do in a geographical sense. So, I think there's some really interesting things happening on the technology field that will push this as well.
And to quickly answer the question about how we're going to scale up things like Triodos and others that have been innovating for a long time, there's sort of good news on that front, because Triodos itself actually convened a meeting earlier this month to talk about creating a global alliance of bankers who are focused on these goals. And I think it gets back to the point that Arthur has been sort of your leitmotif is collaboration on all levels, not only in combining the varieties of financing, but collaboration across enterprises and across sectors to achieve our goals. I regret that we are out of time, having only opened up the conversation, but I think that I would summarize by saying that while this was bannered as a session on moving capital, what we're really talking about here is moving capital, moving capacity, and moving a kind of ownership relationship between enterprises that deliver social as well as financial return for all of us. And I want to thank the audience, because you truly have brought out many other dimensions beyond those that have been presented from here. So thank you very much.